As of January 30th, 2012, a shift in sentiment may be occurring. According to the chart patterns I observe and the analysis I have put forth, a potential reversal signal is surfacing in the market. My name is Thomas Key. I write the charts and define the strategies at Stock Traders Daily. I use candlesticks to identify opportunities either on the long or short side of the curve, and I'll describe briefly what candlesticks are here. A green candle typically represents a bullish environment for either the market or the stock that you're following, whereas a red candle identifies a more bearish environment over that period of time. In a green candle, a stock or a market would open at a lower level and close at a higher level, whereas the red candles open at a higher level and close at a lower level. The body of the candle is where the market opened and closed respectively, but the ultimate lows and highs are considered the legs, meaning that the market or the stock fell down to this level, but it recovered some and closed at a slightly higher level. The purpose of this identification is to help us improve the efficiency of our analysis. Candlesticks are a widely used technical instrument, and anyone that's not familiar with them should Google the term. In practical sense, sometimes bullish candles are not necessarily green, but white. The application I use has white bullish candles, but again, the bearish ones are all red. This pattern shows a sequence of bullish and bearish candles over time. Notice when the market declines, the bearish candles are much longer. When the markets increase, bullish candles are consistent. However, the part I want us to look at is this part right here. This is the longer-term chart of the S&P 500 that we have on our website. I update this regularly, and over this past weekend, I drew a blue rectangle around what could turn out to be a reversal doji. I'll explain what that means here. A doji is a candle pattern that does not have a body. In essence, there is no bullish indicator, there is no bearish indicator, but instead, this doji pattern is an indication that the market lacks direction instead. It often identifies a confused environment, one where the market tried to move higher but failed, one where the market also tried to move lower, but it failed, and instead it closed basically unchanged from where it began. This type of pattern often comes at relative extremes. Sometimes it's a relative high, and sometimes it's a relative low. This formation is a bullish doji pattern, where the market was falling, sentiment was negative, a doji developed, and the indication would be that a potential reversal from negative to positive would surface. However, look what happens when I rotate this just a little bit. When I rotate this image, instead of showing a decline and then a potential reversal, it shows an increase and then a potential reversal. The same doji pattern at a relative peak is a bearish indicator, and that's exactly what I'm seeing now. The doji pattern in the longer term chart of the S&P 500 is a potential bearish indicator. Let's get more specific and peel back some of the layers of this longer term chart. First, let's remove that rectangle. Notice the doji that appears. It's more clear without the rectangle, of course. But it's interesting how perfect that doji formation is. The market's been increasing. It's now in a state where it's confused. At least last week's action identified that. The market failed to increase, it failed to decline, and closed virtually where it opened last week. Since then, at least at the beginning of this week so far, there's been a negative environment. A bearish engulfing doji, which suggests that the market this week closed underneath the lower leg of last week's doji, which exists about 1306. Market's pretty close to 1306 already. If it closes below that level, it could create a very bearish environment and set the market up for another aggressive decline, if nothing more, a shift in sentiment. And that's the purpose of this observation. The market can fall again. Notice what happened last time. At a relative peak, there was a state of relative confusion, and then the market fell. Well, right now, we've gone through a bullish cycle. We're now at a relative peak. A state of confusion has already been identified, and a period of weakness has already begun. If that continues, it can take the market lower again. The conclusion is simple. Get liquid. Become proactive, if you will. If you don't want to, don't. You can just revert to cash. In fact, for people invested in 401ks, that's really your only option. Go to cash and wait. If you're able, short the market, because on occasion, shorting the market is going to be very profitable, especially if the market falls like it has before. However, if you're not able or just unwilling, just wait for the next capitulatory market environment, because it's going to come. Whatever you do, however, do not plug your nose and hope for the best. You want to sell when everything looks good, especially when these reversal signals surface. I want you to keep it simple. After the market falls apart again, you can step in and buy again. The market will fall apart again. You will have another opportunity to buy again. You just need to be willing to sell when everything looks good. There is a reversal signal. It tells us that a sentiment shift may be forthcoming. And if that pattern repeats itself, the market could see the lows set in the summertime again quickly. Get liquid, become proactive, and be ready to buy the dips again when they happen.